Welcome to Sachs Realty's Tuesday night podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday night podcast. We are live like we always are, and I have a real special guest for you tonight. We're talking about mortgages. And I could tell you, if anyone is watching that's in the real estate industry, boy, I tell you what, it seems like it's just getting worse every single day. And, I'm not trying to be a doomsayer, but that's just the way it is right now. We have mortgage applications to a almost 50-year low on originations. We have interest rates that we haven't seen in 23, 24 years, climbing higher, it seems, every single day. We're going to talk about the interest rates. And really, I mean, anyone in the industry is feeling the pain right about now. The buyers have felt the pain for several years now, but now their agents, their loan officers, their title companies, we see a lot of layoffs happening in the industry, and really, guys, no relief in sight the way things seem to be happening. But today we're going to dive in because something is very interesting happening right now that we haven't really seen since the great financial crisis. And it's something that is starting to hit the industry publications, and we thought we would tell you about it. We thought that we'd like to keep you up to date, as you know, if you follow our channel. But the industry publications now are starting to talk about what happens when people go delinquent, default on the loan, go into forbearance like they have over the last 3 years, and what happens to these loans. And we've got a great guest, somebody, a veteran in the industry. I think she's been in the industry almost as long as I have. And someone who has seen it through the great financial crisis to talk about what's going on tonight. So, Melissa.
Hello, everyone. Hi, Todd. And we have a special guest, is right. We have Pamela Vroman. Pam, thank you so much for being our guest tonight. Tell everyone a little bit about yourself.
Well, thank you for having me. As Todd mentioned, I have been in the industry through the mortgage meltdown of 07, 08. I've been in the industry for 23 years. The name of my company I work with is Direct Mortgage Loans. So we are a correspondent lender. I'm all sides of the industry. I'm an investor. My husband is an agent. And like Todd said, I have seen the ups and downs of the industry. So very excited to be with you guys tonight. And
Pam, why don't you tell everybody what's happening right now? What are you seeing in your world? How long have you been in the business?
23 years.
23 years. Yeah, that dates back quite some time. So why don't you tell everybody what is really happening? We hear a lot of cheerleaders out there, they don't like to face the music of what's going on. But why don't you tell everybody the true picture of what is happening in your day-to-day business world?
Yeah. So like you said, we are in a bit of a storm, if you will. So mortgage applications are down. I think you said, like you said, a 50-year low, mixed with the highest rates I've seen in my career. So with that, along with, the topic we're kind of touching on today is that our industry and lenders such as our company are facing mortgage buybacks. And what those entail basically is more scrutiny coming back to us on the lender when borrowers are going into default, when they're late on their mortgages. And when that occurs, basically, our loans then, every detail is scrutinized, whether it's underwriting guidelines, the compliance, the appraisal. They're basically looking for a reason of why this borrower couldn't pay on time. Now, we all know, of course, life happens to a lot of borrowers, illnesses, job loss, things that we as lenders can't control. And I think the thing that is most challenging to us as lenders is that we are encouraged to provide creative financing and provide financing for people who are credit challenged or lower income borrowers. But then those are the borrowers that are going to be at higher risk of going into default. So basically, when a loan is not paid on time, even if the borrower goes late and then catches up, the loan is subject to more scrutiny. And if there is something that was off, say, for example, the appraisal, which is really kind of an opinion in my view. So one, lender could have one opinion, the appraiser has a different one, and then it comes back to us. We as lenders have to hold those loans and service them. When that happens, we have to give back all of the profit that we made on the loan, and we're actually then hit with a tremendous penalty. So when that happens time and time again, we as lenders are losing profit. And when we lose profit, we have to gain it in another way, which, as you can imagine, is passed on to the consumer.
Yeah. So guys, we're going to sort of dissect what happens when we're in a situation like we are right now, where we have really been hiding the reality of unaffordability because we have printed so much money and we have propped up homeowners, borrowers that were risky in the first place. And now as a result, so we're going to try and break this down for you. We're going to try and do it in a way that makes you, not being in the industry, we're going to try and make it in a way that you understand the process. So bear with us a little bit, because we're going to just we're going to deep dive here. So, one of the things that's happening, and Pam, you just said it, lenders are sort of on the hook. So there's it's sort of like a double-edged sword, because you're in an industry of commission-based sales. If you don't produce loans, you don't make any money. At the same point in time, you're on the hook when you push a loan through, and maybe some lenders deserve to be on the hook because they do things that aren't right and could be questionable as to if they're fraud or fraudulent. And we'll dive into that a little bit, but let's kind of, for the audience, explain to them the process. So you have basically two government-sponsored enterprises that sort of regulates the underwriting processes for these loans. So if you could kind of break that down on who these government-sponsored enterprises are, and then kind of step us through like what role they play, because the government wants to increase homeownership almost at any cost, right? They're not, they don't think about the risk side of things. They think about the market side of things, and, how homeownership benefits markets, not, the investors so much that could be, hurt by bad loans. So kind of just break that down for us.
Sure. So Fannie Mae and Freddie Mac are going to be, they are your biggest insurers of conventional mortgages. And then you have FHA, which is a government insured loan. Those entities tell us as lenders what guidelines to follow. So for example, I think it was 2019, there was a guideline that changed regarding student loans and what we as lenders could count as a payment included in the borrower's debt ratio to qualify them. So they're telling us how to underwrite these loans. And oftentimes, that is encouraging us to write loans in a way that, where we can create more loans. So they're telling us, okay, this guideline has opened up regarding student loans, for example. This will allow you to help more borrowers get into homes. However, there can be repercussions with these aggressive guidelines where down the road, then these borrowers are now not able to pay their mortgage, which is kind of where we're at now. So that student loan guideline, they came out with that in 2019. Here we are, fast forward to 2023. Inflation is up. The student loans are now becoming due, mixed with all of these other parts going into it. And these loans that were underwritten back in, say, 2020 or 2019, things have changed. So those borrowers now going into default are coming back to us lenders to be on the hook, even though these entities managed and told what to do by the government are coming, telling us to do it in a certain way, but then it's coming back to bite us. So basically, we as lenders now are having to add what we call overlays. So when we see that a loan isn't performing, even though FHA and HUD may have encouraged us to underwrite it in a particular way, we as lenders are going to then add more conservative guidelines on our own to protect us because these loans are coming back to us, if that makes sense.
So what you're saying, if I understand it right, is that it will be more difficult for borrowers to get loans. So if you're on the hook, it's interesting because I was reading an article, and we're going to pull it up here in a minute, but and I appreciate you coming on, Pam, and talking about this because I only know enough about it, to be dangerous, but this inside and out. But what I understand is that lenders there's a uptick right now in loans coming back to the lenders because of defaults that you're seeing or things that, they're like, hey, like you should have known this. Now the borrower's not paying the mortgage payment. You should have picked up, forecasted this, and you sold us this loan. We bought this loan from you, and now you have to take it back. So there's the financial burden for the lender to do that at a time when your loan originations are at a 50-year low. So you're not making profit by writing loans, and now you're spending money buying these loans back. Is that a fair assessment?
Yeah, it's like a double whammy for us, for sure. And some of these buybacks and this time that they have spent in scrutinizing these files, if we were at a time when mortgage applications were higher, do I believe that they'd be coming back at us with so many? Probably not.
So kind of walk us down. I'm sorry, go ahead. I didn't mean to.
Again, I think the tricky part for lenders is, like you emphasized, we are in sales. We are here to help homeowners get into homes. But the other side of that is we also have to protect them from not going into a home and getting into a property that they can't afford down the road. So it's a tricky situation for lenders.
So explain what a correspondent lender is, and what you guys, when you originate these loans, kind of before we dive into what's actually happening, the rate of these buybacks and how costly it is to the lender. Kind of walk us down through. So when you originate a loan, what happens to that loan? How are lenders paid? And who's buying the loans?
Sure. So as a correspondent lender, we typically lend our company a loan with about 30 to 35 investors. What happens is we complete the transaction. So we underwrite it, we process it, and we fund it. And then after the loan closes, about 4 to 6 weeks after closing, the loan is sold on the secondary market to one of those investors. Some of those are some of the bigger banks that you're probably familiar with, such as Truist, Wells Fargo, Chase, etc. Once those mortgages are picked up by those bigger banks, they service the mortgage. So that's who our borrowers are paying their payments to. We as lenders, as a correspondent lender, earn our revenue from that loan, and it has to perform. So those investors are paying us, assuming that this loan is going to get paid upon. So for example, let's say that I close on a loan next week, and then 3 months later, the borrower sells that property for some odd reason, that we would have to pay back all of our profit because they didn't pay on the mortgage payments. So the profit from the investors is earned through them making payments, and we as lenders, our agreements and our profit is earned that way as well. So one of the hurdles that we as lenders sometimes run into is what's called an early payoff. So there is no prepayment penalty on the loan. So the borrower is allowed to sell the property, but if if it gets paid off early, we lose all of the profit. So then another scenario is, let's say a year, 2 years down the road, the borrower closes, the servicer has been servicing the mortgage, and that borrower goes late on the mortgage. Let's say they go late 1 or 2 times. Those loans then are subject to scrutiny, where they're going to come back to that file and analyze every document in the file. Let's say a compliance document that was missed. Let's say the appraisal that they don't agree with. Let's say sometimes there can be what's called underwriter discretion in our industry. So one underwriter could agree with one set of numbers for income, where the investor's underwriter could say, we don't agree with that calculation, and therefore we want you to buy back this loan. Like I mentioned earlier, when we buy back those loans, we lose not only all of the profit, but we're subject to a penalty as well. So these are incredibly detrimental to lenders. And I think it's a possibility that, you're going to see some smaller lenders that this could actually put them out of business, unfortunately.
So when the investor buys the loan, I guess you say your profits. A lender makes money originating the loan, which the buyer brings to the table in cash. So there's an origination fee. I guess the lender gets to keep that. And then and then when a loan is sold, so when you look at, let's just say, like a $500,000 loan maybe is sold, do you guys make commission on that? I mean, how do lenders make money on selling it to the secondary market?
Correct. So it is a percentage of the loan given back to the company, and then therefore passed on to the loan officer as commissioned as well.
Yeah.
And so when that loan is bought back, all of that profit, all of that revenue has to be given back. So there are about 15 hands within our company that probably touch a loan when it's being completed. So you can imagine all of those salaries, all of that revenue is then given back, and then a penalty is charged as well. So it's huge.
So the investor in the loan, when they're paying the commission to buy the loan, I guess they're agreeing to pay for the loan and offer up a commission to the lender. They're kind of prepaying.
Yes.
I mean, they're coming out of pocket something that they have not recouped a penny of. So they're kind of buying a long-term, profit, like your future
Correct.
income is what they're buying, right?
Right, because they're earning their revenue off of the interest,
right.
And that interest is generated over time, not upfront.
Right. So when you guys are trying to squeeze somebody into a loan product, and you're selling this off, is there at any point of a loan originator's thought process where they're thinking, man, this thing's going to come back to us?
Yes. So especially in the market conditions now, I think we're having to think about that more than ever, to be honest. In my career, obviously, I was in the mortgage industry when we were giving out loans that people surely couldn't afford and did not make sense and were very uncomfortable. These loans now, they actually are well underwritten in my mind compared to then. But the ones that are coming back to us, I could say I can see where some of these clients could have gotten into tough financial times, especially with inflation and these student loans coming due, and a lot of these factors in our environment and the economy that have created this storm for borrowers. I had perfectly viable client 5 years ago, loses job. He was a very solid borrower. Sometimes life happens, but then there are things where the guidelines, it's like, I think particularly I keep honing in on these student loans, but that is a big part of it. And when you're underwriting up to these aggressive guidelines that we're encouraged to underwrite to, I can see where people have gotten into financial troubles, to be honest.
One of the things that I think about is, and I hear about so much of it too. I mean, I heard a percentage, and I mean, I don't know if it's true or not. Maybe you have a better idea, but there are a lot of people that bought second homes, or properties for investment purposes that they had no intentions on living in, zero. And I know, as a real estate investor myself, my rental properties are not residential loans. They're commercial loans, which means that they have balloon payments in 5 or 10 years. It's really hard to get a 10-year locked in rate for 10 years now, when you have a non-owner occupied, even residential property. But I know a lot of people in the last probably decade or so have bought homes with 30-year mortgages that would be considered fraudulent, that they're signing affidavits that they're going to live in there, and they have zero intentions on living there. And
Yeah.
I think about, now they've gone through, financial times with COVID where their tenant didn't have to pay their rent in a lot of cases. And
Yeah.
now these loans are in default. I mean, what do you think will happen? Is there, what kind of liability as far as, fraud in these types of loans on the borrower and the loan originator?
Yeah, so occupancy fraud is a huge issue in our industry. So you're touching on something that's very true. And then if you can imagine mixing that with commission-based employees that are trying to feed their families. I mean, so they have a motivation to get these loans closed, and guide borrowers in maybe a way that, isn't going to be financially stable for them. You touched on something that's very true. During COVID, those the moratorium for people to have that where they did not have to pay rent was a huge impact for investors. So that plays a big role in those loans going to default. Those loans have always, investment properties are higher risk. So if someone says that they're going to actually live in a property, that's a lower risk loan. But then if they end up turning it into a rental, the loan was not underwritten to the correct guidelines, therefore not as much down payment funds. And those loans have, historically always been a higher risk, and probably now more than ever. If someone's going to dump a property, let's say you own 3 homes, 2 of them are rentals, which one are you going to let go of first? Not the one that you occupy.
Yeah. I mean, do you think there's going to be any kind of, implications to the borrowers or the lenders if they're defaulting on the loan, and the real estate investors doing like what you said? They're saying, wait a minute, why is this loan not performing? Why are they not paying the mortgage? And they start looking into it. I mean, it would be pretty easy to search a tax record, or, some type of public record search and see that that's not where they're living, right?
Yeah, I mean, you would think that. I haven't seen that happen yet, but I would imagine that that's coming. Right now, it's that they're going to the lenders first and saying, hey, you digging into that file, trying to find a reason where something was off, so that they can issue that buyback. But I would think the next down the road would be to the borrowers if they can find that there was true fraud on a file.
Yeah. Let's take some questions. I know I saw some things for Pam.
Yeah, some things for Pam. I'm going to hit.
And guys, look, Pam's information's down below in the show notes. She's one of our preferred lenders that, is on our website. I mean, she's amazing. Obviously, if you need a loan, Pam is someone that you should check out and talk with. We're saying right now that there's two types of buyers. There's buyers that are going to buy a house no matter what. They don't care what the price is or what the interest rates are. That's a very small pool of buyers, but there are a lot of hopeful buyers out there too that are waiting for home prices to dip down, waiting for a break in interest rates. I highly recommend, if you're in either one of these, give Pam a try. She is licensed in, how many states are you guys licensed in? 29?
Yeah, 29 are at
29.
DML is. Yep,
Yeah,
that's correct.
Great. Right.
At the top of the show, we had a poll: mortgage lenders bailed out or bankrupt, and the majority of you, 65%, say bankrupt, and 35% say bailed out.
Does that surprise you, Pam? I had a poll you probably didn't know. I said, look, these lenders, we got rough times ahead.
Yeah.
Do you think lenders will be bailed out, or do you think they'll just go away and be bankrupt? Do you think the government will actually bail out lenders, not the banks?
I think it depends on what type of lender. So I think your big players, BOA, those guys, the big names, they're not going to allow those guys to fail just like before. Smaller lenders, correspondent lenders, those guys, I think they'll allow those to fold.
Even though you'll be taking back potentially so much real estate, you still think that they will. What will happen if the lender goes bust and the investor's like, hey, man, somebody has to take this toxic loan? That lender said that they would take it back, and now they're not there anymore. Who steps in?
Yeah, so I think, that's what we were chatting about before the show, those scratch and debt loans. There are places for those non-performing loans to get picked up on the secondary market. And a big part of that will be lenders that have folded that aren't there to pick up those loans, that on the secondary market, someone else will pick it up for, pennies on the dollar.
We have a question for you, Pam, here. Why don't banks do more VA home loans? I took a VA loan out in 2012, could only find one lender in my area, Wells Fargo, only because they moved into my area.
Oh, wow. So I am curious to know where you live, because VA loans should be just as prevalent. In our marketplace, it definitely is. It's one of the first questions I ask to borrowers when I'm taking their application. For pretty much, I would say, gosh, if I had to guess, for any veteran that is eligible, we are putting them into a VA loan unless they're putting down 20%. So I can't see why any lender would shy away from those. Those are government insured loans. So those are, for us as lenders, they're fully insured, and I can't see why any lender would shy away from them. It sounds like, I'm not sure if that's, back in 2012 was different times for sure. But these days, unless you're putting down 20%, there would be no reason for a lender to shy away from a VA loan that I could see.
Did you hear that bird?
I heard a bird.
Did you hear the bird?
A little bird
There's
chirping.
a little bird chirping in here. I forgot to turn my phone off.
Yeah.
One thing that I would touch on when it does come to VA loans that is, and Todd can comment on this as well, that is kind of sad to see in our industry, is that VA loans have a different appraisal process. And because of that, VA loans, the appraisals are scrutinized more. Therefore, when placing offers, let's say there are 5 conventional offers and 1 is VA offers tend to be accepted less often than conventional buyers, simply really because of that appraisal process, right, Todd? That part is disheartening, I will say.
Oh, 100%. Look, coming off of the last several years, of course, now we're starting to see the table turn for these borrowers. But, if you were anything other than cash or conventional, or, someone that had a appraisal gap contingency, where they would overpay appraised value, the sellers weren't accepting their offer. And look, sellers didn't know this stuff if it wasn't an agent pushing it, right? I mean, so agents were historically, if they've been in the business, they know, just like you said, Pam, if you're dealing with a FHA or VA loan, there are different appraisal guidelines that are looking for, I mean, this should be no problem, but are looking for safety problems with the house. So,
Right.
if there's chipping, peeling paint, if there's broken railings, if there's trip hazards, if there's, the windows are broken, not opening and closing. I mean, these are things that should be considered when a buyer's buying a house anyway. But over the last several years, really over the last 10 years, the demand for, the buyers to give up their contingencies prevented a lot of these from happening. And so I don't know. I mean, maybe Charlton was really falling into that, maybe, more of that versus lenders not doing it, but just, having a hard time getting anyone to accept a contract that had a VA
Right.
loan. But hey, I mean, I think one of the problems that we'll see in the next several years are, unfortunately, a lot of the VA buyers that didn't put any money down on their house. And, I don't like that about the VA home loan. I mean, I get it. They're trying to encourage our veterans to be homeowners, and I'm all about that. But it makes it very difficult when we go through shifts in the market where, someone hasn't put any money down on their house, and now they may have to sell because they're relocating. Maybe they're active military and they're, going somewhere where they have to move, and they may not be able to sell their house for what they owe.
Yeah, and a lot of these VA loans, unless their funding fee is waived due to a disability, they're actually starting off over equity because the funding fee that's charged by VA, whether it's 2.125 or 3.3 or 3.6, depending on when you bought and what it is at the time, they're starting off over equity. So if then you add transfer taxes, real estate commissions, if you had to sell your home in 2 years or less, they could be upside down in a tough position to try and sell.
Yeah.
We have a super cash here. Thank you very much for your super cash.
Thanks so much.
How does a cash out refinance work on a house that's paid off?
Good question. So it actually really works very similar to a mortgage refinance that has no loan. It's just that we don't have something we have to pay off. There's no lien that comes first before the new mortgage. So let's say, for example, your home is worth $350 and you want to take out $100,000. There's nothing to pay off. Therefore, your mortgage balance would be $100,000 plus closing costs. Typically, there's just simply nothing else to pay off. So those are, pretty much in the same regard, work the same way as a standard cash out refinance.
We got another question for you here, Pam, as well. How do lenders, brokers feel about these new government-backed 1% down loans to subprime borrowers? Do you see this as qualifying people that shouldn't be qualified?
Good question, comment. So Todd and I were actually talking about these buybacks and loans that we see going into default. And a lot of them are with these low down payment options. Here in Maryland and other states, there are a lot of down payment assistance programs. And the loans that we see the most hurdles on are for borrowers that did not have skin in the game or down payment. So therefore, if they have to give up this property, but they didn't have any money into the transaction, what's the loss if they have nothing else, if they have nothing into it. So it depends. Everyone's situation is different. So loans are like a thumbprint. They're very specific to what your situation is. So will there be qualified borrowers that are well deserving of a 1% down loan? Sure. Are there going to be borrowers in that bucket that are tight as far as debt to income ratio. They don't have much into the transaction. Are riskier borrowers? Sure, absolutely. Anytime we have less of a down payment, it's going to be more of a risk.
Pam, I have a follow-up to that just to clarify. The 1% down loans that are being referenced here, aren't they for your more riskier borrowers?
So we are actually not doing a 1% down loan currently. So we don't have that particular product, but when you refer to subprime borrowers, that's going to be your lower credit borrowers. So
Right. So it's predatory.
Huge risk. I feel
predatory.
like there. Yeah. And like I explained, the tricky part about these guidelines that come down from Fannie, Freddie, and FHA is encouraging us to create these loans, creating these mortgage products. But then for us as the lender, we have to say, oh, you've created this, but we can't actually offer this because it's too risky. So it's a tricky position to be in for sure.
So if you make, let's just say I'm buying a $500,000 house and I make $500,000 a year. Would I qualify for one of these 1% down loan programs?
Since we don't have that product, I'm not sure, but a lot of these products that they come out with aggressive guidelines are typically for lower to moderate income borrowers. So again, that's where it's like they come out with a program to help these lower credit scores, lower income, but they are already at a riskier loan because of that.
And then they're going to make the lender take it back when the people default on it and buy it back and sell it on a second. I mean, it's crazy. This whole thing. I mean, sometimes when I'm talking about these kinds of things, I can't believe the amount of insanity. And that, it's like I sit here and it's like somebody wake me up. I feel like I'm like some kind of, altered state or something where it's like nothing makes sense, but we're told that it does. And this same goes when I want to get into this, Pam's not going to be able to stay on the whole time with us here. But there are some things that I want to talk about tonight. But one of the things that really is crazy to me is despite the fact that we see an increase in foreclosures or defaults, we are now losing COVID money in November. And we're talking about encouraging people to get 1% loans. We're preying on the people that are the riskier borrowers. I know you love to have a house, but you're going to be miserable if you make the wrong choice and you get foreclosed on. That's terrible. And unless they'll keep bailing people out. But they keep pushing this narrative too, that home prices are just going to continue to soar and things are just going to continue to rise. And the bottom line is, guys, that's nuts. That's insanity. That's if we believe that, give up on home ownership, because most people can't afford a $5,000 mortgage right now at a $500,000 house. And we're buying, I mean, here we have really outdated, overpriced houses for $500,000, and people are like, that's a great price. It's crazy. But anyway, there's going to be more to talk once Pam is not with us. We're going to focus on her expertise, keep those questions coming. And I do have some things I do want to show people where interest rates are, by the way, but let's take a couple more questions.
Yeah, take some more questions. Pam, we've got another
Just
one
getting
here
fired up.
for
I think
you.
my Red Bull's kicking in.
Oh yeah, that was good. Charlton just said rant number 1 for you. So we got that one, Charlton. Yeah. Okay. So Pam, what is your opinion on what prices and interest rates will be over the next couple of years?
So if I could predict this, I would have probably been retired by now, but I don't see interest rates coming down quick. In fact, they may even go up a bit more, but I don't think that they're going to go down anytime soon. I think that home prices, it depends on your area. I think it's very specific to location. So we here in Maryland are kind of insulated with the DC, Philly being around us, government. the military bases. So I think it totally depends. It's very area specific, which is exactly what we're seeing here in Maryland, depending on the location. Will determine what the home prices will do. I don't think that they're going to continue to go at the rate that they were, obviously, during COVID. And when rates go down, if they go down, let's say in 2025, I think we'll be back to an insane market similar to COVID, because there is a pent up demand of buyers that are sitting on the sideline that either won't get in the game or don't, or are not able to. That would be just, chaos again. The COVID market, I'm sure Todd can comment on, was not good for buyers. I mean, there was cash coming out of the woodwork. People were paying well over appraised value. So if rates come down, I think we're going to see more of that, which is not exciting. So although we'd love for rates to be lower, I think that the market that will turn us into won't be fun for buyers.
Well, I mean, the problem is the only way that rates will be ever as low as they were ever again is if the government buys the loan. Because
right,
I mean, people don't understand. I mean, the mortgage back, we put more debt in this country in government-backed, mortgage-backed securities, government purchased mortgage-backed securities. They're the only ones that were buying these loans to get people out of the great financial crisis. A 4% loan, a 3.75% loan, a 2.74% loan. The only way this is happening is if the government's buying them. So the government would need to be the only real estate mortgage investor, because nobody on the secondary market, who would do that? Right. I mean,
we're never going to be near those rates again.
I don't think so either, which tells me if we dropped interest rates, Pam, 2 percentage points. I mean, let's take a look at it. Joe, let's pull up what old Google says about rates. Now, I mean, look, rates fluctuate, but first let's take a look at, 640 to 659 credit score with 3% down. And 8.858%. Let's, this is right now. Let's go 800 and up. If you have a perfect credit score, 3% down, 7.979%. Now look, you can buy rates down. You can get on different programs. You can probably get loans for less than that. You could buy a house, a new home construction from some of the builders in some of the states that's running a holiday fall sale or whatever you want to call it, and they're giving you 5% mortgage rates. It's costing them $50,000 to buy down the interest rate to lock somebody into a 5% rate nowadays. It's not practical. But I do want to pull back one of our comments here. I think it was Matthew, whatever. Let's pull that one back up because I want to talk about something. Because, and Matthew, maybe you're a lender. Maybe if you're still listening, maybe you're a lender and you can tell us where you work. Without defending or condemning, just because a loan program is available to a particular subset of the population does not make it predatory. It is not of any good common sense or business practice, in my opinion, Pam, and you can comment on this, to give a risky borrower, entice them to jump into this housing market right now, to pay one of the most expensive premiums to own a home that we've seen in the history of home ownership at a time when the economy sucks as far as affordability for any of these, middle or lower income earners, to entice them to own a home with a 1% down mortgage payment, in my opinion, is predatory, because homeownership is not cheap.
Yeah.
Life's necessities is not cheap. Pam, you don't offer one of these loans probably because you don't want to be in one of these predatory environments. How is it not predatory?
Well, in my opinion, I think that lenders need to set up homeowners for success, for a loan that they can truly afford. The loans that were given out before the crash, obviously, those were loans that people couldn't afford. I think we should be on the hook, and it should be our responsibility to look at these loans from a place of like, can this borrower, with the things that come up in life, financially sustain this, in our opinion, and look at that from all perspectives. So I think, loan programs are great. I love it when there are incentives to purchase. Encouraging homeownership is something that, of course, I want, but making sure that the people can afford that home long term is something that I think that we should all be motivated for as lenders.
How about this? How about most of the people don't qualify for this and they use it purely as a marketing ploy?
Yes.
Yeah. How about that?
Yeah. I think that's, probably part of it. I'm not familiar with this program. I know that there are some programs out there that maybe are similar where the lender is giving a grant, but a lot of times they're giving 3%, but they're charging 2.5%, where it sounds better than it really is if you dig into it. So for that particular program, I would love to take a look at what we call a loan estimate from those lenders and see what it really entails. A lot of times it's not as strong as what you may think.
Anyway, Matthew, I appreciate your comment, man.
Matthew did follow up.
Huh?
Matthew did.
All right, let's follow up. Is he a age? Is he a? I was in mortgage banking. All right. If 1% down is bad, what about 0 down and cost of fee? Look, brother, we just talked about this. You must have just signed on. We just spoke about how we don't think that it could be in the best interest to buy a house with 0% down. No skin in the game, man. I mean, there's look, the problem in America right now is that we live in debt. And it's not how much things cost. It's what do I have to pay a month for it? The problem is that we go through ups and downs. I'd like to know what you're doing right now. 86 to 96, you saw some pretty bad years, right? I mean, I started in 1989. I can remember then coming into the business as a contractor working for home builders. I mean, I got beat quite a bit from, the economy was pretty awful, right? The early 90s wasn't much better, so there's a history of, people doing things that they shouldn't be doing. And that's getting into debt. I mean, we have 1.3, we're working on 1.2, almost $1.3 trillion in revolving debt in this country. We know that 50% of the people that are polled have said that there are plenty of months, most months, many times, that they didn't pay off their credit card in a month. Ask our young people that are now defaulting on their auto loans, on their student debt, on their credit card debt at alarming rates. How about the first-time buyer defaults that are rising in America? Debt. All we're doing is buying people into debt. The problem is that everybody's reaping on these people. Major industries reaping, benefits of this. Investors are going to come in and take the houses that go into default. They're going to buy them for, nickels and dimes on a dollar. It's going to happen just like it did in 2008. I mean, Wall Street investors are on standby waiting for the collapse, right? I mean, so at what point are we encouraging people to buy anything with no money down?
Yeah. And overextending ourselves is almost a part of the culture, if you will, unfortunately.
It's disgusting.
Yeah.
Well,
so we live with the highest mental health rate, issue in one of the highest in the world. We have, people are medicated because of it, right? I mean, it's just and a lot of it's debt pressure, financial pressure. Divorce is from financial pressure. A lot of divorce, right? It's terrible. It's terrible. We need to get back to basics in this country to where we live within our means. We teach people to do it. We hold people responsible. We open up some of this, regulation that is restricting affordable housing in this country and let people have roofs over their heads. I just did a podcast on California. It's terrible. I think they had the largest homeless population of anywhere in the United States. They had the largest working homeless population of anywhere in the United States, people living in their cars, going to gyms, taking showers because they can't afford a house. And now we want to entice them with spending 50% of their income on a house.
Yeah.
I mean, it's crazy. It's crazy. Something needs to change.
Matthew did say, I'm just going to, just as a wrap up of the segment here with Matthew, the loan programs are not at the root of any of the problems. The problem is folks want everything now.
Oh, if we have lenders that are willing to give it to them and entice them into doing it, it's just like cars. I mean, my gosh, man. I mean, some people are paying $800, $900, $1,000 a month for their car.
Yeah. So, and the funny thing was when you say the loan programs are not part of the problem, you mentioned 50% of their income. Believe it or not, we can actually go up to 60% of their income. So I do think that the loan programs are contributing to the problem. They're not just the problem, but when we're not setting them up for success and regulating, these loans to make it so that we're putting people in homes that they truly can afford, the programs have to have some common sense lending behind them.
Man, and this is coming from a loan officer. Thank you.
Mm-hmm.
Thank you for your honesty.
Mm-hmm. We have Super Cash.
Charles.
I was listening to, I think, an anti-crash bro. He was saying homes gained 10 years of appreciation in 3 years and don't expect to fall much. Thoughts?
Yeah, I mean, I can tell you right now. I mean, there are. We can pull it up. Actually, I don't know. I don't want to go out of my context here, but so what we see that are happening here. Let's just pull up some of these listings, Joe. Charles, we appreciate, man, following every week your super chat. We appreciate your support. Let's just pull up these two listings here. So I did a video last week, and there's a lot of market deception going on right now. And what happens is it's easy to, depending on how you look at the data, it's easy to decipher the data to any particular agenda, if you will. I think it's terrible how we are hearing all these people saying that if you don't buy a house right now, you're going to be sorry because home prices are going to continue to rise. Ultimately, over the history of the housing market, post World War II, the housing industry has continued to rise through the years. But there are periods in time where they are higher and lower than other times. And, of course, the largest crash that we experienced was in the 2008 great financial crisis, where we lost equity for, in some cases, 10 or 12 years, meaning that if a buyer bought a house in 2006 at the then peak, then it could be possible that it was until 2022 that they actually could sell that house for what they paid for it. And we were majorly affected here in Maryland with that, as we fell one of the hardest and we were one of the slowest to come back. But certainly as we look with inflation, we're banking on inflation. Everyone wants inflation, despite what the Fed says, because inflation lets people that hold assets make money, right? The problem is that there are periods of time when inflation gets out of hand or out of whack, and that forces prices to adjust or come down until our income can rise. And so when we're looking at the everything bubble right now, the cost of everything, oil that may go to $200 a barrel, where we could be looking at $10 a gallon for gasoline. And this is a realistic, a realistic thing, right? I mean, we really may be looking at $10 a gallon gasoline prices. You're not far from that in California. But let's look at these two listings, because what happens is that there are ways cook the books, if you will. So when we're looking at a house that's priced in this case at $400,000, okay, was the original list price. This house closed at $395,000. So on public record, this sale transferred ownership for $395,000. The buyer is going to be taxed in a property assessment of that sale price, whatever, the percentage of that state or county that they charge to sale value, how they come up with their valuation, that is going to be reflected off of that 395 price. The insurance company is going to be valuing that property at a $395,000 sold price, right? What really happened was that house sold for $385,000, $15,000 less than list price. But the way that they aren't showing that, what you're not seeing in a lot of these cases in the public view, is that there was a $10,000 concession, a seller cash credit at closing for whatever reason. They had an inspection, they wanted money to fix things or upgrade things or do things, or maybe it went towards closing costs, right? This is a number that we haven't seen in years. We haven't seen seller contribution on scale in years. So this is a way that when you're looking at it and they say, well, house prices are never going to come down. Well, when we start seeing $10,000, $20,000, $50,000 cash back at close, and it's not reflected in the sale price, what did the house sell for, right? So this is what we're starting to see happen. This closed in September. We've got another example up here, Joe, if you want to pull that. And this particular one, here you go, 395. It sold for 377. Okay, 377, and they gave the buyer back $11,310 in cash back. So now let's talk about this for a minute. So the question is, are we going to see home prices come down? We have seen home prices come down. We've seen some states that have easily in median price drop 5, 7, 8% since the peak of 2022. It's very difficult when you're looking at year over year numbers because you're looking at the statistics of houses that were sold, and there are no two houses that are exactly alike. But we do know that the prices are softening. They are coming down. Days on the market is increasing, and we're starting to see seller contribution that we haven't seen in years. That, ladies and gentlemen, is a price reduction. It's not one that the public wants to acknowledge. It's not one that the tax man wants to acknowledge. Yes, the appraiser will look at that when they're looking at comparable sales. But one more thing before we go in, and I'll give Pam a chance to answer this question. But let's say that home sales right now are down 30, 40, 50% than they were this time last year. We were in an unseasonably low sales cycle. Number one reason is unaffordability, high interest rate, overpriced real estate for what's on the market. Now, we are working with comparable sales. If you have a subdivision that has 500 homes in there and somebody buys a house, they're going to look at the most recent sold houses in that subdivision. They want to pull at least 2 or 3 comps, houses that were sold in that exact subdivision, because they're like kind built. You can't cross major intersections, jump over into the next subdivision, or the houses may be different characteristic. Maybe they're 10 years newer. So they are looking for sales, comparable sales. Well, when we're only seeing 3 houses sold in 6 months in that subdivision instead of 50, those houses that may reflect distressed sellers taking less money, that, ladies and gentlemen, is your new comp. So we are looking at a time right now that we could be entering the spring market with the worst comparable sales than we've seen in many, many years. That is going to affect home prices, because when they're looking at pricing their home, they're going to say, man, I can't believe the guy right down the street sold it for like $100,000 less than what we think our house is worth. What's going to happen then, Pam?
Yeah. So that's their comp. And we're already hearing that. That's been a thing we hear from appraisers all the time, where they say, hey, I'm reaching out to the listing agent to see where he got his list price because I can't find any comps. Can you help us get comps? So these appraisers are looking on their systems to pull sales, and there's, just like you said, there's not a lot out there. So they have nothing to go off of. And if, like you said, there was a distressed borrower, that's their only comp. Where before, let's say there were 7 comps, they could pick and choose and not include the distressed borrower, not include maybe a short sale, where now that's all they have to go off of. And this has been a hurdle for appraisers for sure.
Pam, who's the appraiser work for?
The lender.
100%.
Yeah.
So even though the borrower is paying the bill for the appraiser ain't looking out for you, Mr. and Mrs.
Right.
Borrower. That's
Right.
not, and you know what? He's not even looking out for Pam. He's not even looking out for Todd. He's not looking out for anybody in the industry. He's looking out for, the one that's writing the check to fund that loan. Because what we started off talking about were the buybacks that's happening right now. And, that appraiser is going to be on the hook.
Yeah, they don't want that coming back onto them either. So they don't want to be scrutinized for an appraisal. So they want the least amount of questions possible and it to fly through underwriting and the secondary market.
So let's go and look real quick at this Inman article. And this is, Inman's, an industry publication. I subscribe to it. It's not something that you guys can just pull up. You can probably see an abbreviated version of this, but you have to pay to be able to look at the articles. But this article, came out the end of September. It says serious mortgage delinquencies could bounce from a 17-year low. Early stage delinquencies have increased for 3 months in a row. And guys, this is going back September. So we're a month worse than we were in September. Early stage delinquencies have increased for 3 months in a row, suggesting that delinquency rates may be nearing a bottom, according to Black Knight's first look at August mortgage data. It's been nearly 30 years since so few homeowners were seriously delinquent on their mortgage. This makes me, I almost have to laugh when I read this. But that trend could come under pressure if early stage delinquencies continue to creep up. Pam, why are we looking at 30-year delinquent lows for mortgage delinquencies?
That is 30-year lows. That's surprising to me that they.
But why is it? Is it surprising that the amount of forbearance?
I think that a big part of that is going to be where these COVID forbearances were allowed. So I would assume that statistic those are not included in there, where borrowers currently are allowed to not pay on their mortgage if they've had COVID hurdles. That's actually coming up in November here. So then I think that real data of who actually is truly late on their mortgages will come into these numbers.
I want to look at this slide in the same article. It says equity insulates many from foreclosure. Again,
Sure.
this drives me nuts too, because I want to look back at that chart here. So if you're looking at this, the blue is tappable equity, right? And I just want to kind of, look at this, because the tappable and non-tappable equity doesn't look in relation to each other much different than it did in the 2005-06 era. Obviously they had a lot of equity in their house back then too. It wasn't as much, but neither was the non-tappable equity. But also, we didn't have the billions of dollars in mortgages that we have now, because home prices have more than doubled since then.
Right.
So, I mean, I don't look at this as such an impressive thing when I'm comparing the hump of the '08 crisis. I look at this as like, wow, we're in worse shape than we are back in '08 because we are dealing with more billions of dollars in mortgage debt than we were back then. Any
Sure.
thoughts on this?
Yeah, so I think this they make a good point with this, that the equity is helping a lot of people afford their homes. So for example, let's say a borrower purchased their property in 2018 and they've gained 100,000 in equity and they're cash strapped and they're having financial hurdles. What they can do is take out a line of credit or a second mortgage or to pull from that equity to afford this home or afford their, lifestyle that's going to run its course and then that the inevitable will be at play. So currently second mortgages are, pretty aggressive. We do a bit of those, but some of the lenders that I work with, investors and other banks, they'll go all the way to 100% on a second mortgage, which is pretty mind boggling to me.
So how's that insulating the borrowers from collapse if they're
Because
taking all their equity?
So what they're doing is, let's say they're in a financial crisis right now and they purchased their home in 2018 for 300,000. Now let's say now it's worth 400,000. They can take out 100,000 to help them afford, pay those bills so that they can afford their mortgage. But obviously that's going to run out at some point.
So their payment doubles from where they were with just the interest rate alone. So now their payment's like doubling. And now they're taking out the money, they're paying more every single month. So that money that they just took out doesn't really mean that much. And
Correct.
They're paying down debt because life is expensive. And, so how's that helping them when they burn through that money in a year and they're back in the same position, but now their default means they have zero equity?
Correct. So basically it's just a matter of time where a lot of those borrowers will get to foreclosure. It's just right now that equity has insulated them, but that's just a matter of time where if their spending is out of control, that eventually the inevitable is going to happen when they run through that cash.
Joe, let's go to the slide that what slide number is this? I want to pull up the one that says interest rates and mortgage origination opportunities. Oh, it's slide number 9. And I want to focus on the cash out refi. Maybe you could zoom in on that and let Pam take a look at this chart. So Pam, this is Black Knight's data. Black Knight's monitoring mortgage activity, reporting on what's going on. I don't know how accurate you consider it or believable that you consider it. Do you believe Black Knight as accurate?
I don't know if I'd be the best opinion there, but
Is that no?
We'll go with no.
Okay. I mean, you can say it. Nobody's gonna get you, in trouble with Black Knight. Who the heck are they? Who cares about Black Knight, for crying out loud? I mean, I think what's happening with, we'll save that for another day. But, I've spoke out about the National Association of Realtors and how, their practices prevent me from, operating a business if I'm not a member of it. I consider them to be more of the elephant in the room than Black Knight, for crying out loud. But let's just look at this, because I think one thing is important here is if we look at the average equity withdrawal. You just spoke about $100,000, taking out $100,000 in equity. People have been sucking it right out of there. Look at that, $100,000. Right?
Yeah. Yeah.
I mean, you can look at this dating back to 2005. It didn't help them to take all their equity out of their house back then.
Right. Yeah.
All right. Well, I think, Pam, we know we have to be considerate to you. And, I know wanted to get out of here at 9 o'clock. So any final thoughts? We have any other questions for Pam?
We do. We have a couple, and I know, Pam, I know you need to wrap it up.
It's a late night here on the East Coast.
Yeah.
No,
9
you're
o'clock.
good. You're good.
You okay? You all right?
Sounds like the baby is calmed down upstairs.
All right.
Okay.
All
We're all
right.
good. Kids are under control.
How about this one, Pam? Pam, do you see any creative financing on the horizon, like 80-10-10 from the old days?
Sure, Graham, that's a good question. So yeah, there are creative financing. So that actually exists now. The thing that we look at when it comes to mortgages currently, mortgage insurance in the last several years has gotten a bad rap. These days, second mortgage rates, so your 10% in this example, are so high that a 90% one loan versus an 80-10-10 may make more financial sense. So the response is that basically the 80-10-10 exists currently and it can be an option, but where second mortgage rates are, it's probably not the best financial option. So mortgage insurance is based on credit scores, and we're seeing that those premiums are actually quite low with higher credit scores, and a better option to go that route.
And we also have another question for you here as well. Pamela, do you think banks took on riskier loans the last few years because they knew they could sell them?
So that's a good question as well. So I think we as banks took on loans that, the FHFA and HUD encouraged us to take because, we were given guidelines that stated we could sell them. So like we chatted about earlier in the podcast, we as lenders are paid off of making loans. And if we can sell them, we want to make loans for as many homeowners as we can. I think we've always been in this weird position where we need to make healthy loans. And now that's being pushed back on to us even more than ever. But sure, they were definitely taking on loans because we were encouraged to in a way, and we knew we could sell them.
If you don't mind, just a few more.
Sure.
That would be amazing. Okay. As
I like
sad,
the
bad,
questions. They're fun.
awesome. As sad, bad as it sounds, will these defaulted houses be sold at a loss by the banks, making somewhat an affordable house for the first-time homebuyers?
So banks, just like any seller, and I tell this to a lot of my buyers, want to sell a home for as much in profit as possible. So I don't see that these defaulted houses will make housing more affordable. Todd, you could comment on this as well. But let's say, for example, a house is foreclosed on. The bank is trying to sell that property for as much as a standard homeowner is. They are not taking those at a loss. They are just as aggressive as any seller in the marketplace.
Yeah, what we're seeing is that, and banks are, I get investors all the time. They're like, oh, there's a bank-owned property. I want to, put in an offer for $50,000 less. It's listed for $500,000. They want to buy it for $450,000 or $400,000. It's the people that are working on the asset, the bank asset. Man, they're sitting behind a desk with a stack of files, and they leave at 4:30. They're off Saturday and Sunday. They could care less about your offer. They're only allowed to accept a certain percentage, which is very small, less than the actual list price. The only tool that they have is time, right? So what they do is they will not drop that price until a set amount of days, and then they'll drop it ever so slightly. They'll leave it on the market for a year. They could care less, right? We have a commercial property that one of my clients wants to buy. It's tax assessed at $6.4 million. Wells Fargo is the lender. Their agent said they would take $3.6 million. All right. Now, $6.4 million is the tax assessment. So we're talking about a property that probably was valued at about $8 or $9 million. Wells Fargo will take $3.6 million. There's a buyer that wants to buy it for $3.5 million. We're $100,000 away from a deal on the property, neither one of them will give a penny. Nobody will meet in the middle. Wells Fargo's like, we could care less. We'll rent it before we drop the price another dollar, right?
Yeah.
And so, people think bank-owned properties. The best time to get these properties, guys, is before the bank gets it back, right?
Yeah.
So if you're a seller out there or you're trying to buy something, look for a potential short sale, because there's a better chance that you will get that before it flops on somebody's desk that could care less about your offer, and more about just trying to profit as much as they can for the greedy bank. And Pam's right. They want more money in a lot of cases than the properties. They're the worst, right?
Yeah.
And not only that, but they think, well, we'll just send somebody in there for $3,000 and repaint and recarpet the place, and it's worth $50,000 more, right? They're clueless. They're clueless. Yeah, it's terrible.
Are not super motivated to move by any means. Like you said, it's a holiday. Oh, we'll just wait till Tuesday to respond while you just
wasting time.
Simmer.
Yep. 100%. And so, what, like I said, if you guys are out there wanting to, get good deals, start looking at properties that say potential short sale. And that means that the agent really thinks that the house is valued for less than the loan amount. We are starting to see those pop up. So, there's great opportunity. It's a longer process to go through. So you can't settle in 30 days. There's a lot that has to happen, but you can get the house under contract for a price. The seller's just trying to hope to mitigate their losses as much as possible. And a lot of times they still have equity, and you can get those at less prices, even paying off the loan, because the seller, just wants it to go away. They're a distressed seller. Distressed seller means that they're forced to sell. They don't have a luxury of hanging around. Some of them are smarter than others. Some of them try and get ahead of it and say, wow, I've got X amount of dollars. I'm not going to be able to afford this house in a year, but let's go ahead and get aggressive with it today. So we are starting to see where, you can get, you can get good prices if you're willing, number one, to fish for them, and number two, that you have an agent that's willing to write as many offers as it takes. And that's why, guys, it's very important that you have the right real estate agent, because so many agents put pressure on their clients and they say things like, I'm not going to write that offer because you're never going to get it at that price. Well, how do you know? First of all, I don't think the agent's making the decision. So, a lot of the buyers need to find an agent that's like, you know what, let's go for it. If we got to write 25 offers, let's write 25 offers. So, that's part of it is, making sure that you're armed with the right agent that will work with you and not pressure you.
Yeah. I also like to encourage buyers to go against the grain, think outside the box. We do a lot of renovation loans. So looking at a property that is in need of repair that not everyone and their cousin is placing offers on, is definitely a good way to get a property under market value and put some sweat equity into it. So I often encourage people to look at those as well.
Pam, while this comment's up, I do want to pull something up, because here's where investors profit on bad loans. So, when the bank gets it back to sell. Number one, a lot of listing agents, they just want the listing. They'll price it at whatever the seller wants to price it at. They don't even care. They just will hang in for the long haul instead of actually telling their seller, like, no, I'm not going to take the listing because you're overpricing it. But let's look at this article on Housing Wire. Again, this is a subscription based. Apologize for, not being able to give you links that you can look these things up yourself. But they're subscription based to people that want to pay. Fannie and Freddie face dilemma in loan repurchases. GSE's missions to meet affordable housing and credit risk goals may be sparking increase in loan repurchase rates. This is what we were talking about with the buybacks, the lenders, because Fannie and Freddie have been pushing homeownership and making riskier propositions to underwrite these borrowers. Now the investors are making the loan originators buy these loans back. And but here's where I just want to kind of go down. Performing legacy mortgage with a fixed 3 to 3.5% coupon was selling for about 75 to 78 cents on the dollar through the whole loan market in late August. Then add 10-point discount for scratch and dent loans. So what's happening here is when a lender gets these loans back, they have to then resell the loan because they don't want the loan. That restricts the amount that they can borrow if people ever want to borrow again, or ever can. They want to unload those loans. So what they're doing is then reselling those loans to investors that are like, well, the first investor kicked it to the curb because maybe there was a couple payments missed. Maybe they did mortgage forbearance and it doesn't look good. But hey, I'm willing to step in and take that loan responsibility on, take that risk, but I'm going to give you 60 cents on a dollar. Maybe that'll drop to 35 or 40 cents on a dollar when we start seeing major fallout of, delinquencies. That's where these other investors can come in and they're like, man, well, if I foreclose on the loan, I get the house.
Yeah.
Right? So now you're starting to see where these investors, that's when Wall Street comes in and they're like, hey, how many bad loans do you have on the books? We're interested in buying them. We'll buy them all, but we're going to buy them at 40 cents on a dollar. And then if the people miss out on the payments and we kick them out of the house and it takes us 6 months or 7 months to get our house, we got a house. Now we can rent it. So, yeah. I mean, what you're talking about as a buyer, like, hey, can I, as a homeowner, get a deal on a bank's, failed, mortgage? No, you're not going to get any discounts. But if you can buy 100 of these loans at 40 cents on the dollar and take them all, and then you evict the people, kick them out, foreclose on them, do whatever you got to do, and you get the house, there's all kinds of money standing around for that.
Right. Yep.
Got a question.
Go ahead.
Okay, thank you. Pam, are you a lender that is offering loans to buy vacation rentals overseas?
Unfortunately, no. We don't do anything overseas. 29 states here in the U.S., nothing overseas.
And I can tell you personally, Pam is very competent. She has helped firsthand our clients, and and she's also been on the other side of the transaction where we've had the listings, and the buyer's agent had Pam, and she's on top of her game.
Mm-hmm.
Thank you.
All right, Pam, you need to jump.
Well, I did just hear her open the door upstairs, so probably time to get the little one into bed.
All right, well, we'll let you go. We know it's late, but hey, we really appreciate you being here, guys. Pam does have a YouTube channel as well. You can subscribe to her. I don't know how much posting she does. She's getting better. Instagram, right?
Yeah, Instagram, yeah, Facebook. Yeah.
And by the way, guys, we do Instagram too. I mean, we're a little behind the. I think we have like 700. Not even. I don't even think we have 700 followers.
It's growing.
Followers. Oh,
yeah, followers.
What about TikTok? Do you guys?
Oh yeah, I think I've got 60. I think I have 60 on TikTok.
That's okay.
But man, I'm trying to get. I mean, it's hard,
Yeah.
If you guys want to support us on our TikTok and Instagram, we'd love it. It would be great.
Please, yes.
Does it sound like we're begging?
No.
Pam, we thank you so much. What a great night, guys. I hope you had a wonderful time listening to Pam and her advice.
Yeah.
Any final thoughts?
Yeah. I think that's it. I really enjoyed it. Thank you guys so much for having me. So hopefully I look forward to returning in the future.
Definitely. Lots of positive feedback. I know that. And they said come back because there's going to be some more questions. So great guest, Pam. Thank you so much.
Awesome. Thank you, guys. Thank you.
All right. We'll see you soon, guys. You're stuck with Melissa and me.
Yay.
For the rest of the duration. We'll hang out for a little bit and answer your questions. See how many you guys, you comment on my rants. I had actually somebody called me up the other day, a friend of mine. He's like, man, they actually count your rants.
They count the rants. There could be some.
They come and go.
Yep. Gambling going on how many wagers, how many you've had for the evening.
All right. And I think we have another super chat. hanging
Yeah,
out there.
actually, we've got a few super chats here
All right.
that I would like to.
We appreciate it. We appreciate your support on our channel. We are dedicated, guys, to keeping you informed on everything real estate. So let's dive in.
Charles, thank you so much again for another super cash. If gas is $90 a barrel right now and it goes to $200 because of the mess right now in California, gas prices could hit $15 a gallon. That's insane. 60% of California fuel is imported from overseas. That's why it's so much.
Yeah. I don't know what percentage of our fuel is imported, period. But certainly doesn't sound good that there's conflict in the Middle East. I think a lot of oil in Russia, maybe. But I think, yeah, everything is reliant on fuel prices as we're coming into wintertime. Utility costs, go up. We start seeing products have fuel surcharge prices on them on a wholesale level. I know as a contractor, buying materials for jobs, getting deliveries, we see fuel surcharges. I just had a dumpster delivered on a job, had a fuel surcharge. These are ways that these companies need to recoup their cost of operation. And it trickles down to just about every product that we use as consumers. So we could easily see fuel go to, on a nationwide average, $10 a gallon. I don't think that would, be unrealistic at all.
Yeah, and this was going to be my next question. I was just curious what it was in California. We had someone give their insight on what's they're seeing there. Here, California gas was already $9.19 and $9.49 for diesel near me. Currently $6.79, all the same station.
Yeah.
So definitely getting expensive. And
right. So we talk about whether people can afford their house price, right? Their home payments. Things are getting tough, and now more and more employers are calling their employees back to work.
Yes.
So we're seeing that a lot.
Yeah.
And starting to hear from people where they're like, now I have to drive over an hour one way to work because they bought a house further out in hopes that they would be working remotely, and their company's saying, look, we're not getting the production and we need you back inside, in office.
The interest rate is just one piece of the puzzle in the financial puzzle. And then you have all of these other things added in, which everyone is, people who aren't educated are focused on what is my monthly rate or monthly mortgage payment going to be. But it's all of these other things added in too, and why it's so important to really be paying attention to your finances.
Yeah.
Did have another super cash here. Charles, again, by the way, Todd, I saw an agent in California trying to push arms. I should link the YouTube story. Rant away.
Yeah. And that's the crazy part is you just heard Pam say that mortgage interest rates, she doesn't believe. We're a 22-year veteran. She's a big producer. She's a heavy hitter. And she has a team. She's a manager of her location. One of the things about lenders is many of them jump from job to job or company to company because they offer them sign-on bonuses. Mm-hmm. So rather than, mortgage originators staying in one place, you're constantly getting emails from them. Hey, just want to let you know, I changed shops. I'm now at this mortgage company or that mortgage company. And it's almost as bad as agents, or agents are almost as bad in jumping ship from broker to broker, thinking that that's the, their magic,
right. The answer to everything.
Move to all of a sudden be successful. But anyway, what happens is when you're buying an adjustable rate mortgage, you're banking on rates coming down. And that's why I hate when lenders say date the rate. That's can be trouble. If you believe that, there are so many people that get burned by this because now they're paying way more for their mortgage in 2 years than they are now. And the rates haven't come down where they can refi. And lenders aren't as forthright when they're signing them up by telling them, hey, by the way, it costs money to refinance. And by the way, we're going to reappraise your house. And if values do decline over the next couple of years, you're going to need to bring a lot more cash to close in order to refi. And then they also don't tell you how long you have to live in the house by the time you pay to refi, pay recordation fees, depending on which state you're in. Some of them are more costly than than others when you file, refile your deed with your new, loan. So there's cost to do that. And when you add all of that up, unless you're staying in the house for 5 more years or 10 years, sometimes these refinancing your loan doesn't pay off. And they're just not telling people that up front. And so that's what you need to ask when they're saying about, these ARM products. You need to ask them, well, what's it going to cost me to refinance in 2 years if rates drop? And how much do rates need to drop for it to make sense? Because if it drops a half a point or 1 percentage point, it may not be worth it.
Yeah, it's very true. They fly around that date the rate so easily off their tongue, and it's irresponsible to not be able to put all the information out there just to get the deal closed.
I was watching a podcast, and it was an interesting podcast, and we've podcasted with him before. Ricky Carruth, remember Ricky?
Yes.
He interviewed, and it's a cool podcast. I don't mind plugging it because it was really, I watched the whole thing. It was like an hour and 20 minutes. It was Ricky Carruth and Grant Cardone. And I think it was just a couple of days ago. But anyway, Grant Cardone was talking about transparency in the housing market, the need for more transparency in the housing market. And now a lot of people don't like Grant Cardone because he's a real estate investor and he wants to own as many doors as he can. And he wants you all to rent these doors and instead of owning a house yourself. But he said something that was very interesting as he referred it to the auto industry, where the car industry was awful in the past and still is sort of, because you go and you fall in love with this car. So they walk you through this process where you do your showroom walk, you pick the car and they tell you about how great it is. And you're like, well, how much is it going to cost a month? And they're, well, we'll get to that.
Mm-hmm.
But let's look at the car and let's pick it and let's drive it and let's love it and pull it up here in the sold lane, right? And then we're going to negotiate on the price. And then I'm going to put you in the box or in the finance department. And they're going to hammer you for as much as they can get you for and see how much you love this car that you just, you just fell in love. You got your hopes up. You took pictures of it. You sent it to your friends, blah, blah, blah. And he was saying that, years ago, he was in the auto industry and that he was telling them back then, hey, you're going to need to be transparent with these buyers. Is this going to backlash on you guys? And now everybody goes into the dealer knowing what the dealership cost is. And what's wrong with that? I mean, why not? I mean, there's fair market value and, negotiate from there. But it's kind of like the same thing in the housing market. We are not being forthright with the buyers in many different ways. And do a adjustable rate mortgage, do this creative product. We're not really telling them up front, like, hey, you're buying the house at the highest, price point that it's been in forever. Since World War II. I mean, the largest price appreciation in the last couple of years, 10 years of appreciation in 2 years. Interest rates are through the roof. Now let's look at, do you still want to buy and what can we get a house for? Like what should we be looking at? What should we buy and kind of work backwards? Because what happens is at this point, all we do is give them a pre-approval or a letter based on today, which has nothing to do with when they move into the house and their insurance rate doubles or quadruples the next year, or that their property taxes are going to go up and this is going to be their new payment, or Let's look at this house and determine what the repair costs are going to be over the next 5 years. So we really need to reanalyze, I think, how we're selling houses and sort of back it down. Like, okay, we're looking at this house. It's a money pit. How much is it going to cost to own this house over the next 5 years? Let's work backwards. And then, do you like the house?
I think that
Do you want the house at that point?
is the way it should be. I mean, it should be laid out in a chart. These are all the fees that you're going to pay. This is the cost you're going to pay. This is what it is. Weigh your different options. I mean, try to take the emotional side out of it and do more education. I think that that's where we need to come from. I mean, we just had a situation yesterday where a first-time home buyer, I went to show them the property, and you were on the other end on a FaceTime call and got to, it's a beautiful home. It's staged. It looks great, but you really were able to kind of dissect the home a little bit. We need more of that.
Well, I mean, and you're right. I mean, what did he say? He said, "Thank you for your honesty."
said,
right?
"Thank
I mean,
you."
look, a couple things with this particular house was that it had newer siding.
Mhm.
And, an agent should be, and that's why, if you're looking to buy a house, you need to look at the historical data on that property. And if I told you the amount of people, the amount of professionals that don't take the time to deep dive into the history of the property, and the buyers, they have no idea. This is a first time buyer.
Yep.
And one of the things, and I don't know that this is a fact or not, but when I went back and I started looking at the photos, it didn't take that long, 10 or 15 minutes of research, that I could see that the house, a couple of, transfers prior to this sale, the house appeared to have asbestos style shingles on as the siding of the house. And sometime in the period of one sale to the next, it was renovated and vinyl siding went up. Well, the question was, do we think they took off the asbestos shingles, or did they just cover over top of it? Because if you're buying that house and it's an environmentally hazardous material that you maybe one day have to, get rid of, dispose of, to do it right is very costly. It could cost you $20,000 or more. And when we looked at the siding, you could see, we don't know what was underneath of that, but we could see that the siding was wavy.
Mm-hmm.
And that's not normal. Either it's a bad siding job, or they did exactly what I said. They covered up the siding.
Mm-hmm.
And it wasn't the idea to tell the guy not to buy the house.
Right.
It wasn't the idea. The buyers make the decision, but you have to give them all of the information that is contained. The other thing is, we were looking at the amount of appreciation that the seller was gaining from the time that they bought it just 7 years ago. And we were able to compare the two property sales side by side and scroll through the photos and see that there was no renovations done. I think that they had looked like that the dishwasher was replaced. But when you're looking to buy a house, you have to look at all these things and consider them. And I think that's what I was getting at with the transparency, is we have to start as professionals. Number one, we have to know what we're doing. And that goes even against some of our licensing laws, because when we're in real estate school, they say, look, all we want you to do is bring a qualified buyer to the seller, or all we want to do as a seller's agent is bring a qualified buyer. And it's like, well, wait a minute. Shouldn't you have to know something? Shouldn't you have to understand building? Shouldn't you have to home construction, repair costs? Shouldn't you have to know some of these things, being an industry professional? I think so, right? How do you rely on a professional to walk you through a home buying process if they're dummies?
Mm-hmm.
And they can't say anything? Oh, don't ask me that. I can't tell you that. Well, I can't give. Part of representation is giving you professional opinions, right? How can you proffer a professional opinion if you don't know what you're doing or don't understand it, right? So I'm not trying to be a siding or asbestos shingle expert, but I can provide the data and say, wavy siding. This picture shows asbestos-like looking shingles. This picture has wavy siding. Do we think they took it off? And that's what I'm getting at here. That's what we need to dive into. And I think as we're looking at homes, one of the things that I would like to see change in the industry is we work it from we work it backwards. Here's the house. This is how much it's going to repair costs are going to be over the course of 10 years. When you get a condominium, when you buy a condo, I know this is law in Maryland now, but when you buy a condominium, why shouldn't this be any type of housing? But a condominium regime has to get reserve studies done, professional reserve studies, so that they can budget appropriately the monthly condo fees to where a buyer doesn't get hurt by moving into a condo and realizing that they're going to have a $20,000 assessment the second year that they moved in, because nobody was looking at deferred maintenance or replacement costs or things like that. Why wouldn't we be looking at housing in the same exact way? Why wouldn't we be telling buyers, hey, in order to maintain affordability here, make sure that you can afford this, we need to make sure that you know what the house is going to cost you living here for the next 5 years, living here for the next 10 years. That's what I think we need, that kind of transparency.
100%.
We would probably have less default, less bailouts, higher affordability.
Yeah, well, if there's more of that, then there would be less impulsive purchasing as well, especially with what we just came out of and everyone feeling they had to rush to write the offer. So I agree with you. I have another super cash. How do the banks keep up with the massive increases in properties in such a short time period? As the dollar decreases in price, I believe the banks are in huge trouble. Where's the money coming from?
I think that regulations, the Fed dropped the overnight trading rate to near 0%, which is the amount that banks or lenders have to pay to borrow money. So if I can borrow money at almost par, I need $50 million, and I can get $50 million from the government for $50 million, and I can create debt where I can get 4 or 5% interest on that money that's not mine, that I'm borrowing at 0% or near 0%. There's a lot of money to be made. And I think that's what their plan was. I think their plan, it doesn't make sense otherwise. It's insanity. What I think the plan was to get people spending money, get them in debt. They use the tool to stimulate spending, the interest rate tool. The interest rate has never in the history of the U.S. economy brought down inflation. Raising rates doesn't bring down inflation. It causes recessions. And in turn, cost Americans everything. And then they have to wipe out a lot of them due to bankruptcies and collapse and foreclosures. And what are we accomplishing? We're putting money in the hands of somebody, some business. It's almost like shifting that money. It's like let's play a scenario. And this is kind of like a great orchestration. If I want a lot of money and my friend prints it and is able to give it to people that need to pay it to me and allow me to raise my rates, my friend printing money just helped me get rich. It's kind of like that.
Mm-hmm.
Doesn't that make sense?
It does.
There's, I don't know if there's truth to that.
I don't know.
Kav, we appreciate you, man. Thank you so much for your super chat. I don't know. As far as I know that some people say that that we should rent and be happy. Some people say that we're going to take all these houses and put them in the hands of investors. We have more real estate owned by investors today than we ever have. They say that like a third of the properties, at least a quarter of the properties, single family homes are owned by companies. There are investors and mutual funds and REITs. And I mean, some people say that that is going to go to 40% of single family houses by 2030, owned by institutional owners. We now see people doing fractional ownership. So they're becoming banks in themselves. We're seeing operators be their own bank by getting people to invest as little as $100. Arrived Homes, Jeff Bezos backed company is doing that. You can buy into a house for $100. So these companies are now creating their own banks by fractional ownership in real estate. And a lot of them sell the real estate for higher than what they paid. So they'll fund a house, buy it at $500,000, offer it up for $550,000 to investors. They'll make $50,000 in this scenario over top for just buying the house. And then they get a fee of like 1% to be the operator or the property manager. Maybe it's higher, maybe some are 8-10% property management fees. So they set up property management companies, and that's what they're doing. So the ones that are going to lose, the ones that aren't on the deed. I mean, if you invest $100 in a house and it doesn't pay you back, you're beat.
Yeah. Along the lines of that, I just wanted to pop this one up really quick. I'd like to hear your thoughts on HomeTap and other equity share companies. I'm starting to encounter people doing this to pay down debt or just get money to live on.
I think I don't like it. I wouldn't want my parents to do something like this. Basically what they do is they say, look, we're not going to give you a loan. We are going to give you up to, let's say, 10% of the equity in your house. So if you have $100,000 in equity, we'll give you $10,000, and we are a 10% partner in your house. And you don't have to pay us back until you sell the house or other circumstances, like you refi, you do something else, whatever. Their contracts are probably very one-sided. And we're seeing a lot of this because people are desperate to get their tentacles inside of that asset, that home, by any and all means, right? I mean, they know that if you have a house, they want it. It's a finite inventory of homes. We have, so many people that are, against building new houses. And these regulations are set up to prevent affordable housing just by the process that developers need to go through. So they're just building McMansions and houses that they can profit hundreds of thousands of dollars on, which average people can't buy. And so these investors want to get a hold of this finite inventory. And they know that because it's finite, eventually the prices are going to become even less affordable, and that more and more people will have to rent. And that's where it comes into what we hear, the rent and be happy. They want you to think that's a great idea. It's cheaper to rent than own. But all the while, a lot of these companies are doing it with other people's money. So, I mean, I could be a great investor too if I didn't need any money myself. And I could just get a percentage of what I convince people to invest.
Mm-hmm. This is a really
weird times.
It's very weird. And why isn't there? I like this question. Why is there no regulation to give a lender a fiduciary role so that they do not take advantage of customers?
Well, I think they're now licensed where they didn't used to be. I mean, I know they're licensed now, and they did not used to need a license even before the great financial crisis. Anybody could be a lender. I don't know. I mean, again, I think personally, I think lenders are going to go away. Pam doesn't probably want to hear that. But I think that like real estate agents, I think a lot of them are going to go away, and you're going to do business with brokers. You're going to do broker to broker. You're going to, call the company up. You're going to call the listing company up, and, and there's going to be a deal made, or sellers are not going to hire brokers at all. There'll be companies out there that will provide cheap legal contracts that cover all the bases. They probably have them now. You can go to the office supply store and buy a lease and fill in the blanks. You don't need an agent to lease your house or apartment. So I think that we're going to see, as transparency opens up, I think we're going to see a lot of our positions go away. There will be people that want agent representation. But I think that as we see banks getting push come to shove, and the banks getting beat by these lenders that are putting together these loans that are going to come back to them, they're going to say, why do we need this lender? We'll just write the loan ourselves. We'll just hire some salaried people like the bank does, and you'll go through the loan process, and that's it. I think we'll see a lot of this consolidation happen over the next couple of years.
Yeah. Talking about the commercial space, a lot of the commentary on TV has been about commercial and REITs. Do you think that a downtown and commercial triggers residential, or do you think the correlation is not that strong, different factors?
Yeah. So there is a cycle in commercial real estate, and it really pertains to multifamily housing. And basically what you have is, you've got recessionary times and boom times. And what we're seeing right now is a time in certain commercial sectors where, the office sector primarily is in big trouble. They say that retail is strong, that it's some of the, the highest return on the investment is retail. And we know that because doing business online is so expensive. A lot of people thought that they would just take their businesses online and, they would run their boutiques instead of having a brick and mortar. And they realized that it's way more expensive to do that and to get eyeballs in that crowded traffic space than it would be to just rent 1,000 or 1,500 square feet of retail space in an area, that's high traffic and the right demographic for their product. So I think that like I said, the biggest hit right now that we're seeing on commercial are office buildings, where even prior to the pandemic, businesses were realizing that they could do more with less people. And they started shaving jobs and reducing the amount of space that they needed because they would outsource more to independent contractors for less than what it cost them to pay for an employee, their health benefits, things like that. And the amount of work loss that they experienced during the day just from unproductive time. I mean, people are people, right? They're going to take breaks. They're going to get on the computer and look at their news and their social media and things like that. So they realize that if they can subcontract that out to somebody else, they don't care what they do. They're fixing in on a price, reducing their overall cost. So we were watching the transformation of office space happen even before the pandemic. The pandemic slowed it down because the government printed all this PPP money and these businesses took it, and they were able to, keep their offices and not think about that for a while. And they let their employees, instead of getting rid of them and looking for independent contractors, they just let them work at home because they had a lot of free money that they could, keep their money and use the government's money. And so now we're seeing this debt come up for refinance, and their numbers, the borrowers are losing their shirts because there's a lot of vacancy. And in order for the bank to refi it, they want millions of dollars for that building. So we're going to see a lot of repurposing these old, outdated buildings that no one wants anyway. So if you do have an office space you want it to be new and revitalized and happening in a great part of town and a good walk score, things like that. So I think what they're going to do is they're going to take a massive hit that the government will probably bail them out. I think they already said that they would. And they're going to put this inventory in the hands of the investors to revitalize. Some of it's going to get renovated. Some of it will be torn down and rebuilt. So what's happening is the banks are going to take the hit because a lot of these big buildings are non-recourse loans. So, I mean, basically the borrowers just like take the keys back. Here you go. Have an office building, 44,000 square feet office building or more. Could be 1 million square feet office park. But will it affect the residential housing? I think what it's going to do is it's going to put a oversupply of residential housing in a multi-family or mixed-use environment because a lot of these office buildings are being converted to apartments. So, I think that's going to be the cycle. I don't think that the direct hit on commercial will affect the residential sector as much as I think the overall job market will affect residential. And that has nothing to do with what I'm talking about with offices. I think that AI is going to replace a lot of jobs. And I think a lot of people will become self-employed versus employees. So I think they'll end up making more money for the people that are innovative and, have entrepreneurial skills and spirit. I think they'll be able to make more money than they would have working at their job. So I think it's the replacement of the people's jobs that's going to really attack our jobs market, affect us financially.
Talking about the
It's a long answer.
It's a long answer, but it was really sink your teeth into it. It was good.
That's right.
It's a good answer. How about answering this one? Because rate is really what we're talking about. What is more important, lower price or interest rate?
Yeah, lower price is more important. 100% all day long. You can't, if you go to sell a house, the old saying of buy low, sell high in real estate is about as true as it gets. The problem with buying high with a lower interest rate is people aren't buying your mortgage. They're buying your home. And when prices decline, you're going to take a hit. So I would say always better. The price is better than the interest rate. I think that look, I think we need to get used to these interest rates. And if I'm wrong and it drops to 5% from 7.5%, then refinance. But use the interest rate to your benefit right now because it's slowing things down, and don't hesitate to slide in some of those low offers because you never know, you might get it. So I think we can look at the interest rate market as a great potential for people that are ready to buy.
Yeah.
Definitely. And guys, look, if you're in Maryland, obviously we want to help you, right? We want you to reach out to us. But if you're anywhere else outside of Maryland, just send us an email. Send me an email. I will get back to you. Melissa will get back to you. We can find out where you live. When you send an email, though, give us your name and your phone number. I get a lot of these emails, and we have to go back like 2 or 3 times before I actually get the information that I need. So if you can send me, what are you looking for? What's your time frame? Give me your name and your number, and then also, let me know if you need a lender too. If you're looking to buy and we need to connect you with a lender, put that in the email too. Just it saves a lot of time. It's going to take a couple of days for us to get back to you anyway, because we do get a lot of emails. We love them and encourage them, but just be patient with us.
Yeah.
But
we're happy to help.
Yeah.
Happy to help. Just be a little patient. But the most information you can give definitely expedites getting back to you.
All right. Any super chats before
I
we?
think we've addressed. Give me just one moment. I'm going to just cruise up here. Yeah, we've already gotten that one. I think we've gotten all the super chats.
We appreciate you guys. We
Yeah.
always appreciate you spending your time with us. And we love it when you share our content too. It lets us know that we're doing a good job. It helps the algorithms get it out to more people so that, we can educate more and more every day. I mean, we're hitting new highs on our channel. We are getting more subscribers. We thank you so much. We love you for it. And anything that we can do to kind of, ease the FOMO that's happening. I hate the narrative that's being pushed right now in the media with, you've got people like Barbara Corcoran that, made a gazillion dollars in real estate, saying that home prices are only going to continue to go up. I think she said, when those prices, rates drop, the real estate's going to soar in 20% or whatever. I'm like, come on, man, let's get off the narrative that, is pushing people to question, whether they should go into debt. There we go. Thanks, Joe. Prices are going to go through the roof. Give me some of that. I want some of that stuff.
Mm-hmm.
Yep.
Yeah.
Guys, I mean, you just have to think for yourself if they're going to go through the roof. You know what? At the end of the day, I may be 100% wrong. I don't think that I am, but who knows? I mean, I don't have a crystal ball. The government could come out with their own loan program and, completely destroy, any thoughts that, I mean, they could give you guaranteed jobs and pay everybody what's necessary to buy a house. They could come in and repair all your roofs and your whatever and give you, free money. I don't know. I can't help that, but I can go by the facts and I can look at not very many people can afford the median home price in America today with the interest rates that equates to a $45 or $52 or $5,400 a month mortgage for a $550,000 house.
Yeah.
By the time you consider taxes and insurance.
Yes.
So that alone tells me, Barbara, the only thing that's going to go through the roof is rain when they don't fix the roof, not prices.
Yeah.
Prices crashing the roof. Downward.
Yeah.
All right, let's take one more.
Okay. We're just going to close it out with this. Is the real estate collapse happening in 2024 and 2025?
And this is a big question. So we know from the peak of 2022, the craziness has pretty much ended. We're not seeing, look, within 2 or 3 days, we're seeing all the buyers go through the house. We put a house on the market. The first week's the most critical. After that, if it hasn't sold, it's crickets, right? And you're begging people. I'm seeing, agents on social media saying, a friend of mine, I just watched his video. I wish he would have invited me because the spread of food looked really, really good. But he was like, hey guys, like I'm here, this broker's open. I've got all this amazing food. And, not that many people are showing up. Nobody has showed up. Come on out and see me because all this food. And I'm thinking to myself, man, I would have had a great lunch. But look, it's happening right now. We are dealing with people in the industry that are struggling. They're exiting the industry. Home sales are at, loan originations are at 50-year lows, 50-year lows, right? The majority of mortgages are under 4%, under 5%, under 4%, 40% of them, whatever, under 3%, or maybe it's 30%, under 3%. I don't know. I've got the stats somewhere. We've talked about it on our videos. It's a lot. People are not motivated to sell. There's a lot of inventory, though, that's going to have to come on the market. And I think the sellers at this point, as we're talking to them, are hoping that interest rates are going to drop by spring because they need to put the house on the market. So we know an influx is going to be coming in inventory in 2024. I think we're going to see between now and then home prices, new comps, new comparables, like we said earlier in the show, start to cripple their ability to get the high prices that they're hoping for in the spring. I think over the next 12 months, we're going to be looking at, a big decline in home prices. Again, nobody has a crystal ball. I wish I could give you guys exact. You guys just got to stay. You just have to keep your thumb on the pulse. Be ready. Keep your credit good. If you want to buy, get with a good agent, and really, don't buy into the FOMO. We appreciate you. We love you. Until next week, Melissa.
Yeah, that's it. That's a wrap. Thank you guys so much again. Thank you for all your comments and questions. And big thank you to Pam Vroman. What a treat to have her here with us tonight. Wealth of knowledge, and got to answer some of your questions.
All right. See you soon.
See you soon.